Hi, I'm Keley Petersen, founder and CEO of Willow Grove Advisors. I often see on social media, in chat rooms, people asking questions, do I invest in index funds or mutual funds? Mutual funds and exchange-traded funds are the two primary ways individual investors can access the stock market in a broadly diversified way. There is a common thought in the market that exchange-traded funds are cheap and mutual funds are expensive, which is actually not always the case. Just because the vehicle you're accessing the market is an exchange-traded fund doesn't necessarily make it cheap, and just because it's a mutual fund doesn't necessarily make it expensive. They're just two different ways of accessing the market. Oftentimes you'll see that a money manager or fund manager will have a mutual fund that they will have managed for many, many years, and they will issue an exchange-traded fund. Same portfolio, same fees, just different vehicles. Each of these vehicles is a tool, and put in the right place and the right portfolio, it gives you the opportunity to optimize that investment. The difference being, an exchange-traded fund, you buy it as a share. You buy it like you're buying a stock. It trades up and down throughout the day. If there's a big buyer in the market or a big seller of that exchange-traded fund in the market, what you'll find is that the value of that share may diverge from the actual value of the underlying pool of stocks that it actually represents. So there can be some divergence in value. But the thing is, with an exchange-traded fund, it's constantly trading throughout the day. The price will change, and over the year, as you hold your exchange-traded fund, it will also give you cash, dividends. All of the companies that are held or are represented in the exchange-traded fund, they'll give out dividends, and those dividends will come to you. So your portfolio will accumulate cash throughout the year, and that cash will sit there until you go in and reinvest it. The one thing that makes exchange-traded funds interesting, in a taxable account, they don't give off capital gains until you sell them. You don't have to worry about capital gains tax until you sell it. So if you buy something today and 3 years later you decide to sell it, you don't have to pay capital gains tax on that appreciation until you sell it. Although you are continuing to get dividends throughout the year, every year, and you will be obliged to pay taxes on that income. Now, a mutual fund is different in that the price is only set once a day. So if you buy a mutual fund, you put in the order at 11 in the morning. At the end of the day, that is when the price sets, and it is always going to be equivalent to the value of the underlying securities in the mutual fund. Throughout the year, those stocks will give off dividends and income. You can set it up so that those are automatically reinvested, and that's kind of dollar cost averaging. It's a great way to just kind of set it and forget it. That cash comes out, it's reinvested at whatever the market is, and as the market's going up and down, you've done some dollar cost averaging. The difference between the mutual fund and the exchange-traded fund, or one of the most significant differences, is maybe a couple of times during the year, the mutual fund is obliged to also distribute capital gains to the owners of a certain date. And those capital gains are the result of trading activity that happens within the mutual fund throughout the year. So you get to the end of the year, and if it's a particularly bad year, say like 2008, the value of your portfolio may be down, but you'll still have some capital gains taxes to pay. If you have a situation where you've got an exchange-traded fund and a mutual fund, same portfolio, same value, then maybe it's really which one you're going to purchase depends on what kind of account you're going to put it into. If you've got a taxable account, the ETF might go into the taxable account, because then you don't have to worry about or think about capital gains. Although you will have to think about periodically going in and reinvesting that cash that comes out. For a retirement account, you don't really care about the taxes, and so you don't mind that it distributes those capital gains at the end of the year. But what you can do with the mutual fund, you can just set it to reinvest. as the cash is being distributed from the dividends and the income and the capital gains, you just set it and forget it and let it go. So mutual funds and ETFs are vehicles to access the market. One is not better than the other. They just have a somewhat different structure and somewhat different tax circumstances or implications. I'm Keley Petersen, founder and CEO of Willow Grove Advisors. We can help you.